Are you concerned about a stock market crash and what that could do to your portfolio? Well, this week I'm going to give you a very simple technique that will help you protect yourself against a crash while still enjoying the upside of the stock market. I'm also going to do my analysis of the overall markets, give you a sense of where stocks, commodities, currencies are likely headed. And then finally, I'll show you a stock that made big gains this past week and a very simple indicator that helped me capitalize on that. That's all coming up in this week's Stockscores Market Minutes. All right, so the first thing we need to get out of the way is that there will always be another stock market crash. And if one happens, what tends to happen is you get these very large, quick drawdowns in the market that takes a long time to overcome. If you think about it this way, if the market were to crash 50%, it then has to go up 100% to get back to where it was. And so we want a method to protect ourselves against a crash, but at the same time, we don't want to stay out of the market. We don't want to miss out on the opportunity. You know, you can be real trigger happy trying to avoid a crash and end up missing out on the gains that happen in the market in general. So I'm going to show you a technique that works pretty well. It will have saved you or would have saved you from the last few market crashes, and I suspect it'll protect you against future ones. And it really comes down to this. We want to look at the long-term trend of the market. And every few years, the long-term trend of the market gets broken with a sharp downward move because there is some catalyst for investors to all run for the exit door. Now, the best time to panic is when the panic should be taken immediately. And I'll explain what that means in just a moment. I'm going to show you a chart in a moment. But we don't want to panic just by small gyrations in the market. We have to have a way to distinguish between the small little blips that will inevitably happen versus the large sell-offs that will ultimately lead to more weakness. So for example, in 2007, 2008, we had the financial crisis. We had a major drop in the market then. In the first part of COVID, we had a major fast drop in the market. And both of those things were fairly easy to predict if you can draw a straight line with a ruler. And that's just how simple it is. You can apply these methods to an individual stock. You can apply it to a portfolio. But ultimately what we're trying to do is exit when the major trend or support zone is broken. Now you're saying, what the heck does that mean? Well, it's a lot easier to understand when we draw a picture. So when we draw a trend line, we're always going to start with what I call inflection points. So these are points where the market stops going down and starts going up. So this is a weekly chart. This is the chart I want you to use. You can go to my website, stockscores.com, and pull up weekly charts of something like this, which is the S&P 500 Index ETF, symbol is SPY. You could do it for the Canadian market, for the European markets, any market you can get charts on. All right, and it's easiest just to use the exchange traded funds. So what you want to do is connect the dots. You want to look for these little floors and then take the line that best fits the floors. So something like that leading into the COVID crash was the best line of support. I've drawn it across the bottoms, across the inflection points, and when that was broken on the weekly chart, which happened early in 2020, it was your cue to get out. Now we can talk about getting back in using the same method. You just draw a line across the tops, and when the downward line is broken, it's time to buy it back. So if we use this most recent run from 2020 into 2022, there is the line that best fits as many of these inflection points as possible. And you can see that in January 2022, that line was broken. That means it's time to get out of the market. Now you can apply this to an individual stock as well. I'll show you that in just a moment. When that happens, get out of the market. You're going to avoid the big downdraft. In this case, the market moved from 440 down to 360. So it's not huge, it's maybe 20% downdraft. But then you could also get back into the market when you have a bullish signal like occurred earlier this year. Now let's apply this to an individual stock. Here you have the chart of Microsoft. And I can do the same technique, draw a line, and where it hits the inflection points, here you can see multiple times when that was broken, time to get out of that stock. And then I could do it for the tops, something like that. When the line down is broken, I can get back in. It doesn't take a lot of time. If you are watching my videos every week, I do this for you anyway, so make sure you're subscribed to the channel, turn on those notifications, because I do this analysis for you every week, and I'll tell you when there has been a break of the upward trend line. All right? Apply this to individual stocks, apply it to the market itself, but the main thing to do is don't apply it to the wrong chart time frame. Don't apply it to a daily chart or an hourly chart, because that's missing out on the big picture, right? The market made a good sustained upward move for many years before it finally broke the upward trend line. And then it went down for a little over a year before it finally broke the downward trend line. Along the way, there were little gyrations which would easily shake out an investor that was looking at the wrong chart time frame. All right, well, let's get into this week's analysis and apply this to the charts that we have going right now. So here is the chart of the S&P 500, and you can see that the market's been moving higher for the last almost year, basically. The bottoms were made in October of last year, and that's very typical. The market tends to be weak in September and then often reverses in October. So we've had some weakness through August and maybe a little bit more weakness coming in September. But unless this upward trend line is broken, I'm not too concerned. Now, we did have a steeper upward trend line that was broken 4 weeks ago, and that was a little bit of a cautionary signal, and I talked about that 4 weeks ago when that happened. I do think we could see a little more downside in the near term because it is September, which is a seasonally weak time of the year. It's actually the worst performing month of the year. Now, let's take a look at the short-term chart to figure out if that is in fact happening. So I can apply that same thinking to this 2-hour chart for the month. And there you can see the upward trend line. You can see the market fell into that upward trend line this week and bounced off of it. That's good. But if it were to roll over here and go down through it, then you should expect more short-term weakness. Doesn't mean the long-term weekly upward trend line is broken. It just means in the short term you're going to get some more weakness. Very typical again for the month of September. Typically you bottom out in October and then rally from October, November until May or June. All right, let's jump to the NASDAQ market. So this is our tech-heavy exchange. There's the weekly chart, and here is your upward trend line. I would draw it kind of like that because I think that best fits as many of these points. And you can see that we've bounced off of it, we've held. But if we were to make this falling top and break down through it, then I want you to be real cautious with the NASDAQ market. What about the small cap market? IWM is the symbol there. Here's our weekly chart. And you can see that we've been stuck in this trading range. This is a optimistic pattern that is building because we have rising bottoms, but it's taking a long time. The small cap stocks have underperformed the large caps, and they need to ultimately break out through this resistance line at around 197.200 on the IWM. If that can happen, then I'll get a little more bullish, but right now it's pretty much a neutral looking market. What about the Canadian exchange? T.XIU is the symbol there, and very similar to the IWM, the US small caps. This market is in a sideways range, slowly building optimism, but really needs a catalyst to break out. So the Toronto Stock Exchange is neutral. Let's take a look at the short-term view. There you can see quite a bit of volatility. Now, volatility means uncertainty, right? The volatility a month ago was much less than it is now. So you're seeing an increase in uncertainty, which means investors are a little nervous. Typical for this time of year, so not a big deal, but still a reason to be cautious. All right, well, let's jump into gold. GLD is the symbol there. And here is your weekly chart. you can see it's kind of lacking a trend. We went down for a while, we went up, and now we're kind of back into a downward trend. So I think you generally want to be careful with gold. Looking at the short-term trend, we were making a little rally there for a couple of weeks. That ended this week, and so we're back into a pullback, and so I would be cautious with gold right now. USO is the symbol for oil. Here's that weekly chart. We broke the downward trend line. We started to build rising bottoms. We've broken through this little resistance level, so I think oil is more likely to head higher than lower. And you can see strong upward momentum on the hourly chart, very short term. I'd like to see it next break through this, but I think there's a good chance it'll come back to this trend line first before it tries to break higher. My outlook is generally positive for oil because the buyers are in control. The bottoms are rising on the chart. Well, let's take a look at currencies. UUP, you can see the breakout through resistance. So that's a positive, indicating the US dollar is likely to go higher in the weeks ahead, and good upward momentum on the hourly chart. This is what we call an upward sloping channel, and you expect it to sort of migrate around in that, but the trend is up. Sentiment stock score very strong. That tells us that the buyers are in control. TBT is the chart for interest rates, which has some relationship to the US dollar, because if interest rates are going higher, and they have been for the last 5 or 6 weeks, that's one of the things that is supportive for the US dollar. And that's one of the reasons why gold has been moving down. A higher US dollar is an indication that gold gets more expensive. It's actually interesting that oil has still gone up despite a strong US dollar. And I think that's on the expectation perhaps that demand for oil is improving. The economy in China may be coming out of some problems, and that might help global demand for oil. GBTC is the last chart we're going to look at. That is the chart for Bitcoin. The trend on the monthly chart, or the weekly chart rather, is upward, but not with a lot of enthusiasm. It's sort of winding its way higher. I think if you're in it and you like it, it's a hold, but I don't see a great reason to own it because it's pretty quietly moving higher. In the short term, quite a bit of volatility, again uncertainty, but generally moving sideways. So let's take a look at my ratings then. Neutral on US large cap stocks and the NASDAQ in the short term, and bullish in the long term. Small cap stocks, bearish in the short term and neutral in the long term. Canadian, neutral on both time frames. Gold, bearish on both time frames. For oil and the US dollar, we see that upward trend, and so we're bullish on both time frames. Bitcoin, neutral, short term and long term bullish. And interest rates, neutral, short term and long term bullish. All right, so now I want to show you a stock that did really well last week, even though the market itself went lower. We saw from those market charts that it was a down week for the overall market. The key to finding these stocks is to focus on what I call alpha. Alpha is an indication that a stock is trading on its own story. And we know this when a stock starts trading with very abnormal volume and making price gains. So this week I've got a swing trade of the week on AXLA. Let me explain why it is the trade of the week. Here is the sign that alpha is in place. August 29th, the stock started trading much more volume than normal and obviously made some big price gains. All right, so you could buy that, but it's actually not the best time to buy because you don't have a good trade-off for the reward potential and the risk you have to take. We want to take trades where the upside is considerably more than the downside. We want to get an indication that the buyers are suddenly excited about the stock where they weren't that interested before. And so to do that, I created an indicator, I call it an action candle, and it measures abnormal price and abnormal volume. So in the chart here, anywhere there's a little yellow dot, that is an action candle. And what I like to see is an action candle that breaks a pullback after the stock was abnormal. Okay, I call that an alpha echo strategy. It's one of the strategies I teach in the active trader program at Stockscores.com, and any of my students get these indicators that they can use on TradeStation or they can watch my screen during the day and we have a real-time alerting for all the stocks making action candles. So AXLA did this, did it a couple times, but most recently on September 6th. Action candle, breaking a pullback on a stock that was abnormal. Your buy point is here. Very low price stock, but very actively traded. This thing was trading hundreds of thousands of times a day, so it was quite easy to take a large position in it. So let's say that was just under 40 cents. Let's round off to 40 cents. And in the rest of the week, it went steadily higher, finishing the week at nearly $1. So in a market where the overall market was moving lower, and you really didn't want to be in stocks in general, you can focus on these alpha stocks, as evidenced by abnormal volume, strong price gains, and buy them when they break from the right kind of pattern using these indicators that will help you do that. Stock more than doubled in 3 days, 2.5 days. So that's the kind of thing that we do at Stockscores. I hope that you'll take a look at the website, go to the trader training area, you can learn more about what we do. Love to get your comments. Do you think we're going to see a weak market in September, or did we get past all of the weakness through those couple of weeks in August when we saw some downward moves? Let me know what you think. Most importantly, trade well.